problem with most people is they're stuck in microeconomy. They don't see the big picture.
Well, so our economic system is in crisis, and I'm really worried now that we're on the verge of a serious economic crisis that could see the destruction of trillions of dollars of additional wealth before this thing is over.
What happened to the English pound? Because that's with the gilts and all that other stuff. Gilts is a government bond or something like that from England.
Right. So that was the second blow we've experienced in the last 2 weeks. What happened there was the new English Prime Minister and her finance minister announced very large tax cuts, very, very large tax cuts, with a lot of this going to the wealthy people.
What does it mean to the English people? Because their pensions were about to collapse, because the Bank of England is the Fed, the same as our Fed, and so what does that mean? So when they start printing more money, what does that mean? Inflation, or are they trying to avoid a depression? What were they doing?
Well, the first move is to try to avoid a depression. That was what they had to do first. They had to act as a lender of last resort. No one else would provide money to support the financial system in England. And so the Bank of England said, we'll do it. We'll create a bunch of money and we'll restore order. And they did. At least temporarily.
That's been the problem since about 1998 when LTCM, long-term capital management, crashed, and the Fed had to bail out a hedge fund. And Jim Rickards is a friend of ours. He wrote the book Currency Wars and all that. His question was back then, who bails out the Fed? And I think we're kind of there now. I mean, that's what you've been writing about in Dollar Crisis and the Corruption of Capitalism. Who's going to bail out the Bank of England? And who's going to bail out the Fed and all the Bank of Japan and all these central banks?
Well, the central banks have had it very easy for the last 3.5 decades because globalization was extremely deflationary. It was pushing down prices and the inflation rate was very low, so interest rates were very low. So they could get away with printing a whole lot of money without causing high rates of inflation.
Right.
And by printing a lot of money, they would buy government bonds, and that would finance government spending and let the government spend a lot of money and stimulate the economy that way. So this was a Goldilocks for 3.5 decades. But suddenly now globalization is going at least partially into reverse. Yep. First, we had COVID and the supply chain bottlenecks all around the world. Next thing you know, Russia's invaded Ukraine, pushing up energy prices, oil prices, gas prices, wheat prices, corn prices, another big round of inflation. And suddenly the central banks are in shock because for the first time in 35 years, they have to deal with inflation. And inflation in the UK is at 10%. It's 10% in Germany. It's practically 10% in the United States. And so now if they try to support the economy by printing more money, that's going to just fan the inflationary flames.
It's happening in China. I mean, they have the biggest bubble in real estate ever, right?
Absolutely. And well beyond real estate, they have excess capacity.
What's going to happen with the Japanese yen, and why is North Korea firing rockets at them?
The Bank of Japan, the Japanese central bank, is determined to keep their interest rates at a very low level. Even though interest rates in the United States and everywhere else, most other countries are going up very rapidly. And so if the U.S. interest rates are 3.5%, Japanese interest rates are only 0.25%. And the Bank of Japan plans to keep them there. And they can do that. But that means no one's going to want to hold yen because you can't earn any money if the interest rate's 25 basis points. They want to sell their yen and buy dollars. And because the dollar, you can get 3.5% interest.
The thing, too, then, is what do you think about the BRICS? Brazil, Russia, India, China, South Africa. The Americans can't see the BRICS. It's out of their picture. Brazil, Russia, India, China, South Africa. And the Belt and Road Project or the Silk Road Project. What do you think those guys are up to against the dollar?
So they used to all be very strong and moving together so they could be grouped together under this heading of the BRICS. but now they're all moving in different directions for different reasons. Russia's economy is in serious trouble because of this ill-advised invasion of Ukraine, and it's not doing very well. And they've got lots of sanctions imposed on them. They can't import any high-tech semiconductors, for instance, so they're going to run out of weapons. So their economy is in crisis. And of course, as you know, I believe that 20 years from now, oil's not going to have any value whatsoever. And their economy is entirely fueled by their earnings from oil and gas. So they're looking at a very dire future, in my opinion. China, they had the biggest bubble in history, probably, but since they have a totalitarian government that can make the banks continue lending and continuing to invest, their bubble will probably not collapse into any kind of Great Depression, but it is not at all inconceivable that they'll just stop growing the way Japan stopped growing 20 years ago. And that'll be a huge change for the world because China's growth has driven the global economy since 2008 when the U.S. stopped playing that role. And so no growth in China is a very big deal. India has better prospects because it's a little more friendly with the United States. And a lot of companies now realize that they probably better move their factories out of China, which the United States is becoming increasingly hostile toward, and move it somewhere safer with a lot of low-cost labor like India. So India's prospects are the best among the BRICS, in my opinion.
And let me give one more business significance of Nord Stream 2 being torpedoed, or satchel charged in the Marine Corps term.
Right. So, well, there's no hard evidence about who did it. So this is purely speculation on my part. But if I had to guess, I believe that Russia blew them up. It was not just Nord Stream 2, which hasn't begun operating yet. It was also Nord Stream 1. Both of them got blown up at the same day, nearly the same time. So Nord Stream 2 hadn't started pumping any gas yet. But Nord Stream 1 had been pumping gas for a very long time until recently. Putin stopped all the gas going through Nord Stream 1. So there was no gas going to Europe from Russia through Nord Stream 1 or Nord Stream 2.
Every time there's inflation, despots rise, like Stalin and Hitler and Mao and all those guys rise out of, hyperinflation and things like this. If China's in trouble and, Russia hit Ukraine, from an American's point of view, sitting in Thailand, what are the odds of China going after Taiwan?
It would lead to a war between the United States and China. And at the very least, it would result in an economic calamity in China because China's trade surplus with the United States, the amount of goods China sells to the U.S. over and above the amount the U.S. sells to China, is more than $1 billion every day, more than $400 billion a year.
That's the trade coming back and forth between China and America? China to America?
That's China's trade surplus. That's how much profit they make every day. More than $400 billion a year that they would lose overnight and never to recover if they invade Taiwan. So that's a very big incentive for them not to do it because unemployment would go up. It would cause social instability. They'd also end up having some of their cities wrecked, and the Communist Party might be overthrown. So that's probably the biggest reason they're not going to do it this decade.
It's happening to interest rates.
Increases interest rates high enough. And all hell broke out 2 weeks ago when Powell put out the Fed's new projections for how high they would increase interest rates. In June, they said that interest rates would be 3.4% at the end of this year. 3 months later, in September, 2 weeks ago, they said they're going to be not 3.4%, but 4.4%. And by the end of next year, he said they'll be 4.6%. So this was a radical adjustment upward in their projections for how high they're going to increase interest rates just over the next few months. And afterwards, that caused a big sell-off in the stock market. The dollar got a lot stronger. That caused problems for the UK pound, and all hell broke loose in the financial markets. And on top of that, not only are they hiking interest rates, but at the same time, they're reversing quantitative easing. Instead of creating money, they're now destroying $95 billion every month.
This is the U.S. Fed. So the U.S. Fed's doing this.
That's right. The Fed is destroying $95 billion a month. Multiply that times 12 months, and that's going to be $1.1 trillion that don't exist 1 year from now that exist today. That's about 13% of all the dollars. As long as the Fed is carrying out quantitative tightening or destroying dollars like that, it's very likely that asset prices are going to keep falling because all of the asset prices are floating on this ocean of liquidity.
So, we could go on forever and ever and ever, and I've kind of led the agenda. Anything you'd like to say to how to prepare for the crash?
So, since the Fed is draining this liquidity on such an aggressive scale and hiking interest rates, the 30-year fixed mortgage rate is now moved up to 6.7%. All of the asset classes are likely to fall together. In the past, it didn't work like that. Stocks would go up and bonds would go down and vice versa. But today, they all move up and down together because they're all floating on this ocean of liquidity that the Fed is now draining. So as long as the Fed keeps draining liquidity through quantitative tightening, all of the asset classes are likely to fall together. So I saw in the Wall Street Journal today, one pundit advised his clients, at least for investors, or being more practical, times like these are not times to look to make a great deal of money. This might be a good time to start thinking about improving your business, creating your own business, getting into business for yourself, something you can control, building up your own business, and worrying less about speculating in speculative assets in the hope that they'll go higher in the near term because they're probably going lower.
So
there will be a day when things turn around. Last year, I was very bullish on the stock market because the Fed was creating $120 billion every month and pumping it into the markets. And as long as that carried on, it was clear asset prices would probably keep moving higher. At least I thought so. But now the reverse is happening. So it's not at all surprising that the stock markets are down between 20 and 30% so far this year. They probably have significantly further to fall. Property prices are probably going to start falling at a double-digit rate by the middle of next year. And things are not going to turn around for a while.
And the reason that's important is because, I said in Rich Dad, Poor Dad, your house is not an asset. That was 25 years ago this year. And for many of the middle class, or the boomers of my generation, their house is their biggest asset they have. And I said, it's not. And today they're crashing. And their housing price, their 401k is probably crashing. And how does quantitative tightening or stopping printing money affect bonds? Because bond markets are the biggest markets around.
Right. So if they just stop printing, then things would more or less be level. But they not only stop printing, but they're actually destroying money now. Instead of printing money, you can say they're unprinting money at the rate of $95 billion a month. And when they do that, what they do is they have these bonds that the government has issued. When they mature, the Fed takes the money from the government. And then the government has to get money from somewhere else, from the public. And that reduces the amount of money that exists in the economy. So with less money, that pushes up interest rates. That makes the bond prices go down and the interest rates, the bond yields go up. So quantitative tightening is another way of tightening monetary policy and pushing up interest rates, and making it more expensive for people to borrow and consume or borrow and invest.
So let me keep it really simple. If I have a bond that was paying 5%, but the new bond is 8%, what does that do with the value of the bond? The old bond.
Right, so it pushes it down,
right?
Because no one is going to want to own the bond that's yielding 5% if the new bonds they can buy yielding 8%. So it causes the price of the old bond to fall until its equivalent yield comes into line. If it falls enough, then the yield would be 8% on that bond as well.
And see, let me explain why what Richard is saying is so important. Is because Wall Street for years has been selling 60-40. 60% equity, 40% bonds, and they're all dropping. It's all dropping right now.